Welcome to Market Monday from the investment team in the trust department at the First National Bank. There have been a lot of consequential events over the past few weeks, none the least of which happened just recently over the weekend in the failure of the Iran negotiations and the potential for a UK-led coalition to be meeting to discuss independently intervening outside of the scope of the United States. So these things materially change the geopolitical playing field going forward, and we're going to be focusing a lot on these events and what the investment implications are and what the economic implications are. But let's start out with a little look back to last week, because that's where the economic story really gets a little bit more interesting with respect to equity prices coming down the horizon. And that is, last week we got the core PCE index, which is what the Fed expects or likes to use to gauge inflation. And that strips out things like food and energy that are considered to be quote unquote volatile. They change a good bit from month to month, so it's not a reliable indicator, a change in one of those on any individual report. However, a change in the trend is. So they're attempting to capture the trend by snipping the outliers, kind of in the sense that a statistician would do that in running studies. However, if you take the analytics point of view, you're going to be looking at the outliers as well because they're relevant and important. And that's the view we take here. The fact is this core PCE still came in extremely hot. 3%, despite the fact that that was the expectations, is still a large proportion above the 2% target that the Fed has traditionally held to, and says eventually they expect inflation to come down to. We're not so sure about that. We're not going to take that side of the bet. But in any case, we also got the number that really matters to consumers who are buying food and gas on a monthly basis, and we're watching that consistently tick up. That was 3.4%, a little bit hotter than expected. And that's natural with the elevated energy prices that flow through to the pump, which also flow through shipping and flows through to pricing for things that consumers want to buy. And let's watch that pretty carefully, because consumer spending in any case, is approximately 2/3 of our GDP. So if the consumer is getting pinched at the pump and cuts back in other areas, it's going to flow through to GDP growth and potentially sends us toward a higher risk of recession down the line. We also got some other information. I won't really cover that. Going into this week, we're going to get another important point. That consumer price index that we just looked at 3.4, well, that's an important input. That shows, kind of as a proxy, what producers and retailers are able to push through in terms of price increases to consumers who are going to continue presumably to buy at that level. If we take the producer price index as an analog for, let's say, input costs, when we look at the PPI expectation coming out in just tomorrow, that's expected to come in at 4.6% of a rise. This is pretty problematic. Remember that last number on PPI year over year, or CPI year over year, where I gave you 3.4? This is going to show 4.6 according to all expectations, and the implication there is shrinking corporate margins. In other words, less dollars per unit sold is the implication, because they're not passing through the full rise in input costs. So we're going to be watching that relationship very carefully in light of energy prices and the ongoing standoff in the Strait of Hormuz that now looks like it's going to last indefinitely going forward. We'll get manufacturing info, we'll get labor market info over the next couple of weeks, this week in particular, but nothing on that order besides the inflation numbers is really going to probably move the markets very much, because the headlines all revolve around this standoff in the Persian Gulf. And let's look at what's happened. This is oil. This is the CO contract. This is Brent crude, which is now trading at a little over 101 or a little under 102 as we get started to the trading day here. It's Monday the 13th. Actually, no, look, I take that back. Yeah, 101.72, whereas going into the weekend, we were down in the mid-90s on news that there was going to be this peace conference, which failed, obviously, over the weekend. Immediately, oil prices are popping back up. Brent crude is what a large portion of the world uses, and it's definitely transiting through the Strait of Hormuz, or not transiting through there very easily at the moment. This is the CL contract, which is our West Texas Intermediate crude, trading at about 103.5 as we get ready to start the day today. Now, with that said, this is an unusual configuration. Oil prices don't usually have the West Texas Intermediary trading higher than Brent. And we're still trying to figure out what's happening. But what's more important is, let's look at the daily, range here. The average daily range between the highs and lows is 9.25 points on the contract, and it's only trading at about 103. So if that's the case, we have a pretty close to 8 to 10% daily swings in the price of crude oil, which is an extreme level of volatility. We don't want to see that, but as long as we continue to see elevated volatility there, we're also going to be seeing individual, the stock indices. Those are in a large enhanced volatility regime as well. To the right pane over here, we've got the S&P 500, which this pattern is looking interesting. So as we go in to the trading day today, futures are down slightly, but a large portion of the drop came back in the pre-market. We'll see if the market can remain above its 200-day moving average and try to keep this pattern kissing 7,000, although these catalysts are pretty strong, and we would expect a strong amount of turbulence going forward. Going into rates, this shows what's happened since the conflict began, and as you can see, across the board, we have higher rates. By a decent margin. These are almost 0.5% in the 3 to 5 year range of the curve, and that indicates that potentially longer term inflation expectations are getting ratcheted higher by professional and institutional investors, and that does extend all the way out the curve, although it comes in slightly as you go further out. The short end remains relatively unmoved, suggesting that there's still this consideration that the Fed is going to potentially control inflationary pressure. However, inflationary pressure is not driven by the price of money and interest rates. It's driven by outlook for inflation going forward. A government bond investor needs to be sure that they're going to at least keep pace with inflation over the course of that bond term, which is essentially a contract. If they buy a $100,000 treasury bond, for instance, they want to make sure that that bond in real dollars, when it gets paid back, is worth the same 100 cents on the dollar, 100,000. If there's inflation expectations, those get baked into the required yield to compensate up to the break-even point that suggests what the inflation risk premium is, or how these investors are viewing inflation. It makes sense to continue to buy the government bond at a certain yield up until the point where that last marginal dollar is not going to break even with inflation, and then stop buying. So that's when we see a yield curve being developed. Now, moving to the left pane, here's the corporate bond curve. That has also shifted pretty dramatically higher. That indicates increases in credit risk, and this was a shift all the way across the curve, even on the short end, which suggests that professional investors are now seeing an increased possibility that corporate credit issuers may default in the future as well, as business conditions get a lot more challenging. And let's face it, this isn't about rates. This is about supply chain reconfiguration that has to happen. This is about the risk that we have a great power naval blockade occurring for the first time in a generation that's officially been called a blockade. We have allies that are potentially intervening on their own terms and not with us. So the world's become a little bit more unstable, and we think that risk premia are going to reset higher for the foreseeable future. What does that mean for your portfolio? It means you want to be aware of these things and you want to understand what's going on, but ultimately, we don't want to be making changes to good long-term investment plans based on short-term events. Come back to this and harp on it every time, but it's worth noting. There was the great financial crisis where we thought the system would break. Here was COVID, where the whole world's trade system shut down. Here was a bear market in 2022 that was pretty bad. And, we had a scare even last year, a volatility spike. But the long-term investor that's disciplined and holding to their long-term plan is going to work out just fine. Volatility can be your friend as much as it is an enemy. It's only an enemy if you get down here and panic and sell and then don't buy back in until up here or even up here. That's when it damages you. So having the plan in place, having a trusted advisor is important. And if you have questions about your portfolio or the implications of current events on your portfolio or your investment plans, feel free to reach out and chat with us. We love to talk about it, and hope you found this video useful. Thanks and have a great day.